Hello and welcome to the first part of our next case study on a hotel acquisition and renovation. And for this case study, we will be going to Darwin in the Northern Territory of Australia and looking at a mixed purpose building that consists of a number of hotel rooms as well as residential apartments. So as always, you can read through the case study document yourself to get the basic idea and to look at all the parts of this case study. But at a high level, we're looking at a plan where we spend about 54 million Australian dollars to acquire this property. We pay about 320,000 per room up front and then about 40,000 per room in the renovation later on. And our plan is to use 85% debt, an LTV ratio of 85% to acquire the property. We plan to start renovating it a year or two after the acquisition. We'll refinance the initial loan or loans that we use to purchase the property when that happens. And then we'll attempt to sell the property after about 5 years. The issue in this market is that it has declined because the commodities boom at this point in time had ended several years before this case study took place. Darwin, Perth, Brisbane, and a few other major cities that really benefited from the commodities boom had seen declining rents and declining average daily rates at hotels and declining occupancy rates and a lot of other negative factors ever since this commodities boom in Australia had ended. However, we think that the market will return to growth. We think there is going to be more domestic travel, and domestic travel actually has been increasing in the city. And we also think there will be increasing numbers of international visitors from Asia. So our plan is to renovate, take advantage of rising market conditions, hopefully, and then boost the property's average daily rate, ADR, and occupancy rate. You can also take a look at the Excel template here. As usual, we're using a lot in the same formatting and a lot in the same setup for points like the debt service and the returns to equity investors. This model and case study, similar to the last one that we looked at for the industrial development, combines elements of the previous one and puts a different twist on it. That twist in this case is that the pro forma of a hotel is very different from the pro forma of an office, an industrial or retail property, and also different from the pro forma of a multifamily property. The main difference is the pro forma. We have very different revenue and expense categories, and items like leases and individual tenants just don't matter because this property has 168 rooms and 133 apartments. So we're just going to look at this at a very high level and look at the overall occupancy rate and average daily rate. So that's an overview of this case study. We are going to look at the acquisition assumptions and hotel pro forma in part 1. Then in part 2, we will look at the debt service, the permanent loan refinancing, the equity returns, and the case study answers. So this part will divide into 4 main steps and look at the acquisition assumptions first. Then we'll look at the shape and structure of a hotel pro forma. Then we'll fill in the revenue and expense drivers for this pro forma. And then we'll fill in the projections, including the revenue and expenses down to net operating income and adjusted net operating income at the end. Now, the way this is presented in the case study document is a little bit different because we have the financing and exit assumptions up in the beginning in part 1. But the problem here is that we can't really fill in many of these assumptions until we have a pro forma for the property. So we're changing the order and essentially going to part 2, the operating assumptions, and part 3, the property pro forma first. We're going from there, and that's what we'll focus on in part 1 of this case study. So let's go to the acquisition assumptions first. Now, the document tells us that we have to create a flexible model because the renovation could take place at any date, and the refinancing with the permanent loan could take place on any date as well, depending on when the renovation actually finishes. So we need to change the setup a little bit. We're still only going to have one possible exit date here, but we need to build in this possibility for the renovation start date to be different. I've already used data validation, Alt-DL, to do this. So we've just selected these 2 dates from down here. Starting in fiscal 2018 really means starting at the end, which means really starting in 2019. And then likewise, starting in 2019 really means starting at the end, so starting in fiscal 2020. Also, with the renovation years, the case study document tells us that we can select from between 1 and 3 years for this. So I'm using data validation once again and setting the minimum to 1 and the maximum to 3. Based on that, we can use the EO month function and take the renovation start date and then the number of years and multiply by the months in a year, 12 over here, and we can get to our renovation ending date. So this setup just means that we're going to have the renovation in 2019 and 2020. The annual renovation factor will be based on 1 divided by the renovation years to complete. When it's 2 years, it's 50%. When it's 3 years, it's 33.3%. This refers to which percentage of the rooms will be unavailable. When we renovate a hotel like this, some portion of the property will be off limits to guests, and no one can stay there because we're renovating and we're performing construction and doing other things to fix up and improve the property. I'll change this back to 2 for now and keep our annual renovation factor there. Now we have some other assumptions up here at the top, but they're not going to play in directly for right this second. The number of keys refers to the number of rooms in the property. Investor-owned apartments, 133, means that we will get management rights and some type of management fee for these apartments, but other people own them, so we're not going to be collecting rent on them. And then car parks is just the number of parking spots in the property, 259. So roughly speaking, it's about 1.54 parking spots per hotel room. For the acquisition price, the case study document, once again, tells us that the price per key is $320,000. We're ignoring the apartments and car parks. Those are sort of baked into the price already, but we're ignoring them here because we don't directly own the apartments. And although the car parks will generate revenue, with a hotel, you sort of assume those have been factored in already, and that when you pay this price for an individual room, you're also assuming that you'll earn some amount of parking income from it. So the acquisition price will just be the acquisition price per key times the number of keys, 168. So it's around 54 million. The implied passing yield is just another way to say the going in cap rate or the purchase cap rate or initial cap rate. We can't fill that in because we need to get to the property's NOI first. And all these other assumptions for the permanent loan refinancing and exit, we also cannot fill in because we need to get the property's pro forma. We need to get the NOI each year. And we also need to fill in the exit capitalization rates. One other point I'll make here is that the acquisition costs here are very high because of something called the stamp duty in Australia. It varies based on the territory or state that you're in, but essentially it is a tax that's paid when property transfers hands. Now, similar taxes exist in many other countries and cities, but it's especially high in Australia. Part of the reason it's high here is that, as you'll see in a bit, there are no land taxes in the Northern Territory, so they make up for it a bit by having such a high stamp duty. I'm simplifying, but that's one way you can think about this. Let's go to the sources and uses of funds, and as usual, let's start with the uses side. So first, we have our acquisition price up here. Then for the acquisition costs and stamp duty, this one is 6% of our acquisition price, so let's multiply those. And then the loan issuance fee, we take our acquisition price, we multiply by the loan to value ratio of the acquisition loan plus the loan to value of the mezzanine, and then we multiply by the 1.5% loan issuance fee. All of these numbers are coming directly from the case study document, if you're wondering where I'm getting these from. Let's add these up. And then for the acquisition loan, let's take our percentage right here and multiply by the acquisition price. And then for the mezzanine, let's take our percentage here and multiply by the acquisition price. And then for investor equity, let's take our total uses and let's subtract the acquisition loan and the mezzanine. Let's add these up, and our sources equals our uses, which is what we want. That's about all we can do with the acquisition assumptions for now. So let's go to the hotel pro forma. And before we get into the revenue and expense drivers, I want to walk you through what it looks like and explain how and why it's different from what you might see for an office, retail, industrial, or multifamily property. The revenue categories should be pretty straightforward. We have rooms, which is obviously where a hotel earns most of its revenue from by selling its rooms to guests who stay there and pay a daily rate. They may also have food and beverages. They also charge guests for internet and phone service and other types of telecommunication. And in this case, since it is a mixed-use property, we're also earning some amount of management fees from the investor-owned apartments. And then parking, most hotels charge guests to park their cars, and that's what this corresponds to. The department level expenses are similar to cost of sales or labor or cost of goods sold for a normal company. And these are the direct expenses associated with each of these categories. For example, for room operating expenses, we have the cost of paying the cleaning staff to maintain the rooms and the repair crew and maintenance crew and any staff that's directly involved with maintaining the rooms. And the same applies for everything else here. Gross operating income is very similar to gross profit for normal companies. Then undistributed expenses are similar to the ones above in that they depend heavily on the usage of the property. So when the occupancy rate is higher, both departmental expenses and undistributed expenses will be higher. But the difference is that these don't correspond neatly to a single revenue category. For sales and marketing, for example, this corresponds to winning guests and maybe paying commissions to travel agencies and online booking sites. But it's not as if you can directly link these expenses to a single revenue category up here. These are sort of like operating expenses for a normal company because they are incurred, but you can't necessarily map them cleanly to single revenue categories. These all depend on usage as well. So for example, when more rooms are in use, you're going to need to spend more on repairs and maintenance. When more people are staying in your hotel, you're going to have to spend more on utilities because they're using more electricity and water. Then we get to house profit, which doesn't have a direct analogy for normal companies, but it tells us how much we have available to pay for fixed expenses, renovation costs, capital expenditures, and anything else that appears below this line. With fixed expenses, the distinction between these and undistributed expenses is that fixed expenses exist regardless of how busy the hotel is or how occupied it is. So even if we have only 2 guests staying there out of 168 rooms, for example, we're still going to have to pay the same amount of property taxes because these are based on the property value or the number of rooms or the square feet or square meters or something like that. The same goes for insurance. Even with replacement reserves, no, we may not be spending as much on these items with fewer guests, but we're still going to put about the same amount into reserves, and it's based on the overall size of the property. And with the ground lease, it's the same thing. This refers to the fact that some hotels do not own their own land, and if they do not, then they have to lease it from someone else, and this is that leasing expense. And then finally, the renovation costs at the bottom refer to the $40,000 per room that we're paying in renovation here, and these will be spread out over 1 year, 2 years, or 3 years. You should already know net operating income and adjusted net operating income, but it's easiest to think of these as being similar to EBITDA or EBIT for normal companies for net operating income. And then for adjusted net operating income, this is more similar to unlevered free cash flow because it does include the impact of capital expenditures or renovation costs here. Below that, we have the debt service, and you should already know how this works from the previous case studies. We have interest expense, paid in kind interest, and principal repayments as well. One other thing I want to mention here is that with the reserves, we do have reserves, but we don't have tenant improvements or leasing commissions here. It doesn't make any sense for a hotel because no one stays in the room for a long time. No one can request tenant improvements. So these reserves correspond to furniture, fixtures, and equipment in the rooms and common areas. And we're not going to go through the business of building up a reserve and then releasing it based on the cash payments each year. It's just not worth it because we have so many rooms and it's hard to directly assign many of these to specific hotel guests. So we're going to skip over all that and just assume that the number here represents roughly what the hotel is paying in cash for these over time. Let's go to step 3 and look at the revenue and expense drivers. Now, these are all pretty straightforward because the case study document lays out everything for us directly. I have some notes over here on the side on a few points that are a little more difficult, but overall, this is a pretty straightforward exercise. Let's actually start by entering this row for renovation factor, and we'll say if the current year we're in is beyond the renovation start date and it is less than or equal to the renovation ending date, then we'll go up and take our renovation factor. Otherwise, we'll say 0. And you can see how it works here. When we have a 2-year renovation starting in fiscal 2020, we get 50% each year. If we were to change this and make it a 3-year renovation, for example, then we get 33% each of these years. Because of the way this is set up, the first one is a greater than because when the renovation start date is December 31st of one year, that really means that it starts on January 1st of the next year. However, the second part is less than or equal to, because when renovation ends on December 31st, it means it really ends on December 31st of that year. Now, for the ADR, we know we're starting at 210. The growth rate will be negative 4%, negative 2%, and then we'll have a sudden turnaround, and we'll go up to 10%, 7%, 4%, and 3% in the stabilized year. The occupancy rate similarly will fall at first, so as this region continues going through a downturn, but then we think it'll start rising after that and eventually go up to 80% by the end. Now for the average daily rate, let's take our number and then multiply by 1 plus the growth rate here. Copy this across, and we have that. For the days and period, for this one, we can actually just take the dates and subtract. Take the date of the year that we're currently in and subtract the previous one. And so we have that. I'm just using the EO month function at the end because we don't have the year filled in column E here. Now, the revenue per available room, or RevPAR, is an extremely important metric for hotels. You calculate it by taking the average daily rate, multiplying by the occupancy rate. This tells you essentially how much you could earn on all your available rooms in the property. It's useful because if you just look at the average daily rate, it doesn't necessarily tell you that much, especially if the hotels have different occupancy rates or in different markets. Because if one hotel is occupied 80% and the other is occupied only 50%, the average daily rates might be similar, but the revenue potential is going to be much higher at the one that's 80% occupied. So the revenue per available room, or RevPAR, gives us an indication of that and lets us more easily compare different hotels. The available room nights are just what they sound like. We take the days and the period, and then we multiply by the keys, 168 here. So this tells us essentially how many opportunities we have each year to charge a guest to stay in our hotel rooms. And then for the occupied room nights, we take our occupancy rate and multiply by the available room nights. But then we also have to multiply by 1 minus this renovation factor. And you'll see how this works when we copy it across. Initially, in the first few years when there's no renovation, this is around 70 to 75% of the available room nights. But then as soon as we get this renovation happening, the availability immediately goes down by about a third, and then it only recovers in the stabilized year at the end. So we need to do this because this is a much cleaner setup than going through and trying to multiply all the revenue and expenses by this renovation factor. So that's the approach we're taking here. Now, with the rest of these, the food and beverage and the telecom revenue, the management fee, the fees per occupied car park, again, these are all coming to us straight from the case study document. So for these, the growth rate for all these is supposed to be 3%. They say 3% pretty much everywhere. So let's take these and just copy them down. And then for the actual numbers, let's take the old number, multiply by 1 plus this growth rate. Copy this down. And then we'll do telecom revenue per occupied room night. We'll do it for the apartment management fees as well. And then we'll do it for the parking fees as well. For the parking fees, we also need to figure out the number of occupied car parks. To calculate this, let's take our occupancy rate. We'll multiply by 1 minus the renovation factor. And then we'll multiply by the number of parking spots, 259. And we have that. And you can see that once again, we get lower numbers in these middle 3 years when the renovation is taking place. Now, for the margins, the room margin is supposed to increase slightly. So it'll go up to 77.6%, 77.7%, 77.8%, 77.9%, and then 78% in the final 2 years. The rest of the margins are going to stay the same. You should understand intuitively that the rooms will have the highest margins because it doesn't really cost that much to pay staff to clean and maintain these rooms. Food and beverage will have lower margin. Yes, it is marked up very heavily at hotels and resorts, but not as heavily as you might think. It can also be quite expensive to transport food there, especially if it's in a remote location or somewhere where food has to be imported, for example. With the telecom margin here, most hotels actually lose money on these services. They can charge guests, but sometimes they have to give it away for free, or sometimes they cannot charge guests enough to cover what it actually costs. So it's very common to see negative margins here, meaning that the hotel actually loses money with its telecom services. And then the apartment management fee and car park margin are both pretty straightforward. It's just what it costs to maintain parking spots and what it costs to service the apartments for which it has management rights. So if someone needs repairs or has to change something about the apartment or has other issues that come up, this represents the margin on those services. All these undistributed expenses are just simple percentages of revenue. So let's take these and copy them across. These are almost always around 5 to 10% of revenue or less. You will rarely see them go much higher than this because for most hotels, you don't really need a gigantic staff to manage the property. Really, you just need to make sure the rooms are well maintained and clean. But most of these expenses tend to be far less significant than everything up here for the departmental expenses. And then for the fixed expenses, all these are also going to grow at 3% per year. So let's just copy down our formula for utilities, for insurance, for property taxes, and for reserves. And then once again, we can take the same exact formula that we had above and just copy and paste it down here for everything. The ground lease will be 0 because we own the land here. And if you're wondering about the property taxes, this is a point that's specific to the Northern Territory and Australia, but there are no land taxes or property taxes of any kind there. Instead, there's just the stamp duty when you buy and sell property. Now, in other territories and states of Australia, there is a property tax and it is paid out on any type of commercial real estate. But in this particular case, we don't have anything here for the property taxes. Looking at these, you can also see why these are all classified as fixed expenses because they're based on the available rooms. They're not based on the occupied rooms or the occupied room nights or anything like that. We're going to pay these regardless of how occupied the property actually is. And then finally, for the renovation costs, once again, we need to do a check and see if we're in the renovation year. So if we're beyond the end of the start date and we're also before we're in the renovation end date, then we're going to take the renovation per room of 40,000 right here. We'll multiply by the number of keys. That's what we're spending on each room. And then we have to multiply by the number of rooms. And then we're going to multiply by the renovation factor up here, which tells us what percent of these renovation expenses are going to be distributed into each year. And there are other ways we could set this up as well. For example, we could just take the renovation costs and multiply by the percentage up here and do that instead. But this is just the way I've chosen to set it up here. Let's also do a quick check and make sure the totals match. So about 6.7 million. We said 7 million in the case study document, and it seems like they do. Let's fill in the numerical years as well. So let's include all these. And with that, we have set up everything that we need for our revenue and expense drivers. Let's go to step 4 and fill in the hotel pro forma projections. These are mostly very straightforward. Keep in mind the apartment management fees are going to be there regardless of the renovation or the occupancy. With the departmental expenses, keep in mind you're multiplying by 1 minus the margin percentage because you're looking at the expenses here. Undistributed expenses are simple percentages of revenue except for utilities. Utilities will not be based on revenue because it's based on the usage of water and electricity in rooms. And then with the fixed expenses, almost everything is linked to the keys. One exception is the ground lease, which is 0 here because the hotel owns its own land. So let's start with the rooms in the historical period. For this one, we need to take our occupied room nights and then multiply by our average daily rate right there. For food and beverage, we can do something similar, and we'll just take our occupied room nights, and then we'll multiply by the food and beverage number. And then for telecom, let's take our occupied room nights and multiply by the telecom revenue per occupied room night. For the apartment management, we can take our management fees per apartment right here and then multiply by the number of investor-owned apartments. And then for parking, let's take our occupied car parks right here and then multiply by the fees per occupied car park. Moving down, for the room operating expenses, let's use a negative sign because we're dealing with expenses now. We'll take the room revenue and then we'll multiply by 1 minus the percentage right here. We copied that down, we add these up, and then let's take our revenue, our departmental expenses, and then for the gross operating margin, we'll just take this and divide by our total revenue at the top. We'll anchor that so we can copy it around more easily. The undistributed expenses are mostly percentages of revenue. So for administrative and general, let's take our revenue right here. I'm going to anchor the row part so we can more easily copy it down in the future. And then I'll link to this first percentage. I should have used a negative sign there. And we're linking to our sales and marketing, our repairs and maintenance, and our management fee. And then for the utilities, we'll link to our utilities per occupied room night and multiply by the number of occupied room nights in this year. We'll add these up. And then for house profit, we'll take our gross operating income, subtract these undistributed expenses, and then we can calculate the margin on that below. For the fixed expenses, let's go up and take the insurance per available room and multiply by keys, in other words, the total number of rooms that we have. For property taxes, even though it's 0, let's just fill this in so you have something here. And then for the renewal and replacement reserves, let's take the number per available room and multiply by the keys. And then finally, for the ground lease, this one will just be 0. So let's add these up. Net operating income is our house profit minus these fixed expenses. And then we can calculate the margin on that. Now, for the renovation costs, let's go up and link to our renovation costs and just flip the sign and make it a negative. Adjusted net operating income will be our net operating income minus those renovation costs. And then we have our adjusted NOI margin. So we have that. And with that, we have now finished down to the adjusted NOI line item. So let's copy all of these across. And so that's set up. If you want to check this, one thing you could do is try changing the years and try starting this in fiscal 2018 to the end of fiscal 2018. So really fiscal 2019, and go through and see if the revenue drops like you expect it would, which it does in this case, goes from 10.7 million to about 7 million, then rises gradually and rises again near the end. We could try changing the number of years, for example. And in this case, we have renovation costs in those 2 years, but nowhere else. And we also see that same issue with revenue being a lot lower, expenses being a lot lower, and house profit being lower, and also net operating income being significantly lower. So those are a few ways you can check it, but we're pretty much done now. I'm just going to leave this set to 2018 for the renovation start date and 2 for the number of years to complete this. Let's do a recap and summary now. Just like some of the other models we've seen in this intro module, this one combines elements of previous case studies and modeling tests here. We're still going to be funding the deal with debt and equity. We still calculate the IRR and the multiples. And just as in the real estate development case study, we assume that the initial loan or loans get refinanced. The only difference is that we start out in a stabilized state, go away from it, and then move back to it here. The main difference with this model is the pro forma, because the revenue and expense categories are quite different. There are hundreds of rooms or apartments here, so we're not going to look at individual leases or anything like that. We're just going to look at the numbers overall and look at a property-wide occupancy rate and average daily rate. We started out with the acquisition assumptions, and you saw how to calculate them based on the price per key. You saw how to make the calculations for the renovation year and how to set up the sources and uses schedule based on our debt and equity assumptions and purchase price. Then we went through what a hotel's pro forma looks like, and you saw how the categories are closer to what you'd see for a normal company, which is why we think that hotels overall are the most similar to normal companies out of everything here. We have revenue, departmental expenses, which are all directly linked to that revenue, undistributed expenses, which are like operating expenses for the hotel, and then fixed expenses that will be there regardless of how occupied or vacant the property is. We went through and filled in the key drivers for revenue and expenses from the case study document right here. You saw how we got to all of these numbers. And then based on that, we filled in the pro forma for the property and calculated the net operating income and adjusted net operating income in each year here. Now, the renovation in the middle definitely depresses these numbers, but it's not going to be a huge issue by the time we get to the end of it. I just wanted to set this up so you can look at it and check your work and make sure you understand what we're doing. That's it for this lesson. Coming up next in part 2, we are going to look at the debt service, the permanent loan refinancing, the equity returns, and the case study answers. Now, that may seem like a lot, but keep in mind that a lot of it is very similar to previous exercises we've completed. And also, there are only a few case study questions at the end, so it's not going to be too much of a stretch to finish it in around 30 minutes.